Good morning, good afternoon, Multifamily Investor Nation. I am Danny Randazzo. I'm going to give it just a minute or so before we get started. We will let everyone log in and get up to speed here. While everyone is joining, I'm going to ask if Hannah can please share the link to the upcoming summit in June. For those of you who are interested, it's going to be a great event. The link to review the event and purchase a ticket will be shared shortly. So look for that in the chat box or the Q&A box while everyone is getting logged in. And I'm going to wait probably about 2 minutes. I will start at 11:05 Eastern. And so sit back, relax, get set up, make sure your technology is working. Hopefully you can hear me clearly, and we'll get started in just a minute. While I am finishing getting set up here, in the chat box, let me know where you are joining from, country or city and state. I hope everyone is having a good start to the week and a good start to the year. Today's session is going to focus on underwriting for apartment syndication or apartment investment purchases. While we are getting started, I am Danny Randazzo. I am a managing partner at passiveinvesting.com. If you want to learn about what we do, check out our team, how we're set up, any sort of current offerings. If you want to invest passively with us, check it all out, passiveinvesting.com. The other important spot, join the club up here in the top of the right. If you are interested in being a passive investor with us, getting on our mailing list for opportunities, or even if you are brand new, just joining the club to have a conversation with one of our investor relations team members. That's the best place to do it so we can see if it's a good fit. With that being said, let me see here who we have coming in. We've got San Antonio, Texas in the house, Greenville, South Carolina. Hopefully you are dug out from the snow this past weekend. Excellent. Chicago, welcome. Hello, people. How is everyone? Boston, Mass, Memphis, Tennessee, Chicago, Indiana. Excellent. Very good. Welcome to today's webinar session. It is all about underwriting strategies for apartment syndication deals. So typically the way this works, I'll probably chat for, the next 20-25 minutes with content. I always save time at the end. Winnetka, Canada, if I said that correctly, I hope, Kenneth. Long Island, New York, welcome. So I'll speak for the next 20-25 minutes about underwriting strategies. We do these webinars every week for all of you out here joining us. So this is meant for you. Please ask questions throughout, even if they're unique to you. Feel free to ask them. Use the chat box, use the Q&A box. I will do my best to manage all of those boxes to keep up, but feel free to stop me throughout. If I get on a roll, I'll try to pause and get some questions. But again, this is designed for you guys and gals out there. So if you have an underwriting issue, if you have said there are no good deals out there, if you have said all the deals I look at don't pencil out, my underwriting doesn't work, then this webinar is for you. And we're going to get to some of those reasons why it may not be working, how to adjust it, and really to become a better financial underwriter for deals that you're looking at. So, with that being said, let's dive in. I don't think I've missed any questions yet, so I am all caught up and ready to go. Strategies for underwriting apartment syndications deals. Again, this webinar is going to be brief. We're not going to be able to spend the time to get into the nitty-gritty details, but I wanted to share with you an important resource. So on YouTube, we have the Multifamily Investor Nation channel, and we've got over 4,500 subscribers. So if you haven't done so, subscribe so you can follow along, but all of the content gets shared here. And so one trick, if you have not done this before in YouTube, in this search function, when you click on the channel, if you just type in underwriting, you are going to get a bunch of videos. So 3 years ago, entry-level strategies, the basics about underwriting, a great video for it. I think it's about an hour long, but just on here, we have all sorts of underwriting tactics. We have outsourcing your underwriting. If you are not the numbers person, if you don't like working with an Excel, maybe you're not the best person to do that. We have a multifamily investor nation summit panel all about apartment underwriting. We have additional videos that Dan and myself put together about analyzing your deals, strategies for underwriting. I'm just kind of scrolling through here, and we've got, let's see here. We've got quite a few videos. I'm guessing this is probably, close to maybe like 50 or 100 hours worth of underwriting content. Areas where we've talked about underwriting. So that being said, we have a ton of content available. So if you're not getting some of your more detailed questions answered, go check out these videos. Part 1 and this one, part 2, are very, very good to get your entry level kind of Excel. We pull it up, we go through an underwriting model. So those are some great resources and tools for you, all out there in the Multifamily Investor Nation YouTube channel. So that being said, Lingo, you should know prior to underwriting your first deal. This is a very important step so you can understand what pieces of information you need to request from a broker or a seller. And then in addition to that, what information inside those reports means and how it works. So, when you're underwriting a deal, the first 2 major items that you need to have access to from the seller is a rent roll. So this is a report that summarizes the total number of units and the typical square footage per each unit and what each unit is rented for. In addition, some very good rent rolls will also include what other income items are being charged on a monthly basis. If there's an amenity fee or pet rent or some sort of technology package or a TV, cable, internet fee that gets charged on a monthly basis. Again, very important to know what those items are and how the rental income breaks down in detail. You want to know how much each person is paying for rent, but then also any other fees that are associated with that. Being able to understand the rent roll gives you a good visibility into how the property may be operating. So one of the things that I like to do when I first open up a rent roll is I like to kind of filter for the same sized units. And I like to understand what the units are renting for. Are they all renting for exactly the same amount, or are some units renting at higher price points? Did a new resident just move in to a certain size unit and they are now paying the most rent of anyone else in a like kind size unit? It gives you that ability to really judge what market rents are. So a lot of times you'll get an offering memorandum from a broker that says, hey, market rents are $200 more per unit. And that's a good kind of BS tester. If you can look at a rent roll for a unit that was rented just last week, if it's getting $200 more in rent than the other units, then you're verifying that sales pitch the broker has made. However, if it's getting the same or potentially less rent per month, I wouldn't trust what that broker's saying, but I would also start to ask some very pointed questions about what's going on with the rental rates. It doesn't seem like we can get $200, Mr. or Mrs. Sales Broker. I think you're full of BS, but help me understand what's going on here. So rent roll, number one important report to get from the start as far as underwriting goes. Second most important report, your T12, trailing 12 months of income and expenses. This could also be called like a year to date, but the T12 is basically a summarized by month with the last 12 months of information, total income generated per month as always at the top, and then all of your expenses are below, and the expenses are bucketed into very specific items like payroll, repair and maintenance, turnover expenses, legal fees, real estate taxes. What else do we have? Utilities, advertising, marketing. So all of the basics, everything that it takes to run a property. In the part one underwriting video on YouTube that I showed you, I go through in detail each of those buckets and kind of what the rough rule of thumbs, the expenses per unit costs are for each of those expenses. So again, that's very helpful. If you don't own a property at the moment and you're like, how much do we spend annually for marketing, or how do we budget for that? Check out that video and you're going to get that kind of rough rule of thumb. Always check with your management company, whoever is going to take on that activity for you, to make sure that it fits for your market. But that's the items to know what a rent roll is, know what a T12 report is, and make sure you know what those expense items are and income items are in the report. If a tech fee on the rent roll is something that you don't understand, just ask the question to the broker to define what this means. It's always important to know the correct definition for something, because terminology across owners or management companies can differ, and it means a great deal in one capacity, and it could be a great deal in another capacity. So if something seems unclear, it's not silly. You're not going to look bad if you just ask a question that says, hey, clarify what tech package means, what's included, what's not included, or clarify what employees are in the payroll schedule. Just having some line item that payroll is $200,000 a year is good information, but you also need to know, what is that payroll doing? Do you have a full-time manager? Do you have a full-time leasing assistant? Do you have a full-time maintenance supervisor and a full-time maintenance tech in those categories? So you have to understand that. You have to make sure you know what makes sense. Underwriting rules of thumb. Very important step to know where you are looking at. So every market is different. It's important to note a few items here from a rule of thumb perspective. So, one thing that we always do with our underwriting is we make the assumption that there is going to be a softening of the market over our hold period by having an exit cap rate expansion. So if we're buying a deal, let's just say at a 4 cap, we would expect to sell that deal most probably at a 4.5 cap, meaning the market is going to soften over time. So the rule of thumb is to always be conservative with your underwriting and build that expansion in. You would not want to buy a property at a 4 cap and assume the market is going to strengthen and you could sell it at a 3.5 cap. That is not good underwriting. That is not a good approach to having conservative investments out there. So cap rate expansion, one rule of thumb that you should always build into your underwriting. Another rule of thumb to build into your underwriting is in terms of rent growth or rent decrease potential. And this is really driven off of local economic and demographic metrics. One of the sources of information we use is CoStar. CoStar will do very detailed and thorough studies of population growth trends as well as rental rate trends for specific markets. We predominantly and really only invest in areas where there is growth in population and growth of jobs in markets. And so what that drives, it creates a good economic environment where rental rates should be increasing. And so we use that source of information, the CoStar rental rate projections for a 5 or 10-year period, depending on what our hold is, and we will build in some sort of conservative rent growth projection into our underwriting model. And so if the CoStar report or if another source of information is projecting maybe a 5% rental increase in year one, we may conservatively assume that we're going to have a 3% rental growth rate once we stabilize the property after we take it over. And so again, conservative rent growth, or in some markets, you may actually have decreasing rents. And so you would want to build in a negative growth assumption. I wouldn't suggest you buy those deals with negative rent growth assumptions. It just doesn't seem like a good long-term market. So I'd steer clear of that, but it's a good rule of thumb to know what rental rate trends are for your market that you're investing. It's not on a property by property level, it's really on a market level. So it might be, like the Raleigh metro, or it could be a sub market within the Raleigh, North Carolina market. Or, if we're talking about New York City, you may have growth trends for Brooklyn. You may have growth trends for Manhattan, right? Those different submarkets. Very important to get those pieces correctly. Another rule of thumb from an expense projection, right? Typically, you'll have a good idea of what it annually costs to run and oversee the property and pay all of the bills associated with the property. However, it's an important piece to know where inflation is going in your market or having some sort of annual expense increase. So the same type of research and information and knowledge about rent growth trends, you also need to get that on expense trends too. To have a conservative underwriting, typically we always have a couple percentage points of expense growth. Whether you use it or not, it's important to build that into your model. Ideally, you always want to have some cushion in your underwriting to beat income projections and beat expense projections. If for some reason you're in an environment where one is lower, you might be able to offset and still achieve your business plan and still stick to your underwriting. So, what we always say within our company is we want to have a couple of levers to work with that gives us some cushion. So, maybe if our expenses trend a little bit higher than normal, maybe we can try to dial up and get better rental increases than we underwrote, and we're still net neutral or beating our underwriting. So that's always the goal, is to really beat your underwriting. And worst case scenario, at least you can match your underwriting. So those couple of rules of thumb there around your rental trends, your expense trends, as well as your cap rate expansion. Those are great pieces to get you started and to be conservative in your underwriting. Lastly, couple important things here is know the financial world and know the financial metrics. So if you cringe when I say IRR or cash on cash or an Excel underwriting model, then underwriting is really not for you. You need to have a passion for it. You need to have someone on your team who can really get into the weeds and the nitty grittiness of Excel and underwriting and measuring these critical investment metrics. So what we do when we look at an underwriting is we really look at the goal or the output of these financial metrics. And if the deal doesn't work, then we don't go after it. If it works, then we kind of work backwards and say, okay, let's review in more detail each of these line items now that a deal has qualified based on the IRR, or the internal rate of return. The IRR, or your annualized return, or ROI, return on investment, is really the measure that you take into account to decide whether it's worthwhile to invest in anything or not. So if you were to invest in a stock, and let's just say the stock, we knew exactly what it would do at the end of the year, and it was going to be a 3% appreciation. We all would probably say, you know what, I'm going to pass on buying that stock to get a 3% return, because I could do this other investment and make 6%. So I might as well get 6% instead of 3. But if you're looking at these multifamily deals, you may say, hey, I can get a 10% return on my money each year over the next 5 years. However, I know I've been conservative in my underwriting. Hopefully, we can do better than 10%. And maybe you go after that option because you know exactly how you've evaluated the deal, that there's some room, hopefully, to beat your projections. So again, it's important to be conservative. You never want to try to overreach or stretch your goal to have a 50% IRR or 50% return on investment in a 1-year deal. It just doesn't make sense. So know what you're doing, know what those terms mean. So know what cash on cash is. So the cash on cash return is if you put in $1 million in equity to buy a deal, how much cash flow are you earning year over year? So in the first year, you might earn 5% cash on cash return. That means you'd get $50,000 on your $1 million investment. If you were getting a 10% cash on cash return, that means you would make $1 million on, or excuse me, $100,000 on your $1 million investment. So it's important to be able to judge and kind of measure what a metric is and how it relates to you personally. So you may have an investment opportunity that's a 3-year deal, and it could have a 25% IRR, but zero cash flow. And that could be a great deal for you if you are actively making income elsewhere, right? You don't need monthly cash flow to support your lifestyle. On the other hand, you could have a 3-year deal that maybe has a 10% IRR, but you're also making 10% cash on cash year over year. And so you're making money each month, and you may want that if you are trying to, quit your job to get into real estate full time, or just have extra income coming in to pay the bills, save up to go on another family vacation, so on and so forth. So it's very important to understand what the metrics are and how they relate to your personal goals. Everyone is different, right? Every investment is different. And it's just important to understand the basics and what metrics you need to look at to really evaluate, is this the best decision for my money? Is this the best decision for investor capital? And how do we, again, always be conservative in our underwriting? So with that, I'm going to pause. I'm going to go to the Q&A box in the chat box. So if you have questions, this is your time. Please ask them. One of the questions in here, does CoStar do rental projections by class of property? The answer to that is yes. CoStar can generate some reports. It's a fairly expensive service that you have to pay for. You can't share your access. They really do a great job of like geo tracking your logins and what devices you log in from. They really have have kind of cornered the market in that sense. So a lot of professional institutional investors use CoStar to use the data that they have. We subscribe to it. We use it. It's good. You can get data that is specific to your property, as well as you can get a good data set based on like kind comparable properties in the metro. So there's a button, you can click it and you can get a report with like the 10 comps for your asset. So it's very helpful, definitely worthwhile to have that. Okay. Does price per door or price per square foot influence your decision more? Price per door is a good measure to see if you are acquiring the property in a um in a in a good range based on other comps in the area. Price per door and price per square foot should really be pretty equal. So if there are 5 comps in your market and all 5 of those properties sold for $100,000 per door, I'm guessing the price per square foot should be fairly similar if you took a ratio of that. And so using the price per door or price per square foot, it's a good it's a good gut check to say, okay, I'm buying a 100-unit property down the street. Am I paying about $100,000 per door based on the comps, price per door, and price per square foot? I would look at both of them. It's a good, quick gut check, like I said, to make sure you're in that range of pricing or putting an offer in to potentially buy a property. Are you creating a new model from scratch every deal you underwrite, or is it a plug and play that gives you the metrics? It's a plug and play. So what we do is we just have a base underwriting model with a bunch of zeros in the sheets. And once we update our inputs with the new deal specific information, the model automatically generates the metrics we need. And so theoretically, I could fill out the numbers in 5 or 10 minutes and evaluate a deal very quickly. As long as we have good numbers and good data to input. And we do that all the time. We'll do a quick underwriting to see, hey, does this kind of gut check pass? Are we getting the metrics we need? If we're not, then kick it out. Don't even waste any more time looking at it. So you definitely need to be comfortable with underwriting, comfortable with Excel to do it quickly. So you can look at a lot of deals. And once a deal, hits the metrics you're looking for, then you spend a couple hours going through it and really fine tuning it and reviewing it. Best websites to get market rents or comps. Apartments.com is a good spot just to go and look at like what comparables are being listed for in the marketplace. Calling properties, going to tour properties and looking at actually renting a unit is one of the best ways to get rent comps. Asking brokers for deals that have traded in the market, if you're trying to look at sales comps, is another good way. CoStar is obviously a great source of information. You do have to pay for it. What else is on here? I think there's some population trend information, even if you just like Google Raleigh, North Carolina population growth, you'll probably get some instances. What else? I think that's it. I feel like we've also done a webinar on some good resources for comping and how to comp properties. So check that out as well. Do you care more about IRR or equity multiple? So, theoretically, at a really high level, the IRR and equity multiple should be roughly the same as a test. So I don't think you care more about one or the other. It's just which one makes the most sense for you to quickly look at. So IRR basically tells you what your expected annual return should be for a deal. It takes into account time. So that's why it's not a true annualized return. That's why it's called an internal rate of return. So, if a deal is a 5-year hold with a 20 IRR, your equity multiple would be a 2. So it's very relational between the two. You just need to figure out what is comfortable for you to use. So personally, I like to think about IRR because it's a rate of return on your money that measures things equally. Equity multiple, right, can be sometimes misleading. If I say I'm going to give you a 5 equity multiple on the investment, it sounds like an awesome equity multiple. But when I tell you that it's a 100-year deal, you're not going to get your money back for 100 years. Now it's not so good of a deal. But in that example, with a 5 equity multiple on a 100-year deal, your IRR might be like 1%. And so it's very easy to see like, hey, that's probably not the best deal for me at this time, despite the equity multiple is really, really high. So I like IRR, but I also like to look at all of the numbers just being a finance person. What exit cap rate do you use? We typically have a 50 basis point expansion in cap rate. That's just a general rule of thumb. It differs based on market, differs based on property type, differs based on quality of asset as well. What do you look at to consider pursuing a deal? Cash on cash and IRR are very good thresholds. You need to figure out again what you are interested in. So going back to my 5 equity multiple on a 100-year deal, right? No one on this webinar is probably interested in that long of a hold period to make 5 times your money. So figure out what metrics are good for you and what you're looking for, and then go out and find the investment to fit your goal. Do you guys have a goal for the amount of deals you underwrite in a year? Does the person underwriting get the broker info? Once the deal is underwritten, how does the underwriter speak with the team and learn about the deal collectively? So the person underwriting should go and get the raw information so they know it's right. If the deal qualifies, the person underwriting the deal should present it to the greater group to review it, ask any questions, and then do a detailed line by line review of the underwriting. As far as the goal for the amount of deals to underwrite, we work backwards to get there. So if our goal is to buy 10 deals this year, and if we looked at, if our goal is to buy 10 deals this year, the rough kind of rule of thumb is you underwrite or you look at 100 deals, you make offers on 10 and you win 1, right? You win 1% of the deals that you look at. So in order to get to buy 10 deals, right, we need to look at 1,000 and underwrite 1,000 deals in a year. We need to make offers on 100, and then we can go and buy 10. So that's the rough rule of thumb. Work backwards to get there. If you're trying to buy 1 or 2 deals, you may need to look at a couple hundred, but you also might get lucky and you might look at 10 and you might buy 2. So think about your goals, work backwards to get there. How do you get phone numbers when these databases don't show it? Not sure what you mean about phone numbers. What databases do you use to get owner phone numbers? We buy our deals through brokers. So I would use like whitepages.com, do some sort of, I don't know, sleuthing on the internet to find the phone number. Where there's a will, there's a way, if you need to get it. Do you have a model available for those just getting started? Yes. Hannah, do we have the link to our resources that you can share with the team? I think we have something on the Multifamily Investor Nation page with a generic underwriting model. Cash on cash is paid monthly or every 3 months. That's the questions for LP partners. We do monthly cash flow distributions. Some operators do quarterly distributions. It really depends on the deal type and the operator. And again, what is best for the property itself. Okay, I'm going to finish these up in the chat box. No slides, only the registration page is what I am sharing. You're not missing anything. Let's see here. Okay. There we go. Price per door. We talked about that. We talked about that. We talked about IRR, equity multiple. We talked about that. How do you determine market cap rate for modeling? Yeah, cap rates are driven by market comparable sales. Cap rates are available. I talk to brokers about what deals are trading at, what sort of cap rates they're seeing. Evaluating deals in a market is, again, the best way to do it, because a cap rate is the sale price or purchase price of a deal divided by the net operating income. And so if you know what the NOI is for a property and what it traded for, you can calculate what the cap rate was. Consider pursuing, we talked about what metric, quick 5-minute decision. I think I talked about that one, Michael, as far as, it can take you 5 or 10 minutes to do a quick underwriting on a deal to see if it passes at a high level. Yeah, I'm just sharing the landing page for the webinar today, kind of talking about these 4 bullet points. Exit multiple. How much emphasis do you place on the equity multiple? Roy, it depends on time, right? So if you had a 1.75 equity multiple on a 12-month hold, that's a pretty great deal, right? A 75% return on your money, basically. So take into account the IRR, but having a good multiple, if you're trying to buy a apartment community doing a syndication with a 5-year hold projection, I think you need to be around that kind of 2x multiple where you can double your money in 5 years. That seems to be a kind of sweet spot. Of course, there's different scenarios. You could certainly have a higher than a 2 multiple. You could certainly have something lower than a 2, but a 2 is a good rough rule of thumb to kind of shoot for. IRR and cash on cash returns are really dependent on you as the investor and the operator. So, some people who are retired may want a higher cash on cash return and a lower IRR for an investment opportunity. Some people who are still, working full-time jobs and just want to put money away for retirement way down the line, they may want a high IRR but lower cash flow. So that question, I'll just flip it back to you and say, what would you invest in? What's acceptable to you from an IRR or a cash on cash return perspective? I'm going to have time here for a couple more. TruePeopleSearch.com, along with white pages, are helpful resources for owner phone numbers. People Looker is another good one. Best source for deals: get them from brokers, get them from the MLS, get them from sellers, talk to property managers, find a bunch of deals. Ultimately, you need a ton of deal flow, right, to look at, to then make offers on a 10% of them, and then to buy 1% of the deals you look at. What markets are we currently invested in? We're in the Southeast US, Raleigh and Charlotte, North Carolina, Greenville and Charleston, South Carolina, Orlando, Florida, Dallas, Texas, Houston, Texas. I'm thinking what else here. I think those are the big hitters. Carolinas, Florida, Texas. Some advisors are saying compressed cap rate market. We should plan for a longer hold time, 7 to 10 years. Um, Absolutely. I think having a longer term plan is a good piece. So evaluate your deals specifically, and make sure that it's conservative. The couple of sites, truepeoplesearch.com, someone recommended here in the chat box as a resource to track down owners. Whitepages.com, another one is People Looker. So I don't know any of these personally, but just good resources. Also the Google. With that being said, I am signing off. Thank you all for joining. I really appreciate the active participation. It's always fun to, kind of talk for a little bit and then answer a bunch of questions. So great content in here. Have a great afternoon. Next week, Tuesday, same time, same place, right here online, 11 a.m. Eastern. Make sure you sign up for next week's webinar. Make sure you check out the Multifamily Investor Nation Summit coming up in June. Buy your ticket. It's going to be a great event. That being said, have a good rest of the week. Be productive. Go underwrite some deals. Go get a bunch of deal flow. And then hopefully next week you're asking me questions now that you have a deal under contract, and we'll get to it. So thank you very much. Have a great week, and we will see you next time.